Okay, great. Well, Manish, welcome to Applied Securities Analysis. I think I mentioned to you, but it's a class of about 75 students, a mix of first and second year Columbia MBAs. Really appreciate you making the time to speak to the students and join us today. Really lucky to have you, and I know all the students are really excited to have you here and listen to your thoughts, and also see what questions you have for them as well. Look, Manish really needs no introduction, but I'll provide a brief background. He's the founder and managing partner of Pabrai Investment Funds, which he founded in 1999. Prior to that, he started his own IT consulting company, Transtech, in about 1991, and I think it was with under 100,000 of savings and credit card borrowings, which he turned around and sold for about 20 million in 2000. So he definitely has the entrepreneurial blood in him, which I believe has been a little bit of an inspiration from his father. Look, he's one of the most well-known value investors of our time. Is really well read, as you can probably tell from his reading list that he puts on his website, and has a really fascinating background. So, look, it should be a very fun and lively discussion today. He's written 2 books, which I'd highly recommend all of you add to your bookshelves and reading list. One, The Dando Investor, which I believe, tell me if I'm wrong, but it's the Gujarati word for endeavors to create wealth, or something close to that, I believe, Manish. And The Mosaic. And then finally, he's also started the Dakshana Foundation that helps impoverished students in India train for the IIT and medical entrance exams. Before we begin, Manish, I just also wanted to introduce you to my co-professor, Michael Herman. Mike, if you just quickly say hello. I'm just trying to find you on my screen. But
yeah, I'm here. Hi, Manish. Thank you so much for taking the time.
Great to be here.
Great. So Manish has suggested we do just go straight into Q&A. And I guess his only request is that the students send no easy pitches this way, or I guess he'd like to call it only deadly curveballs. So I hope you guys have some challenging questions for Manish today. I thought he just it's a great quote. And we have about an hour. So, Manish, I was thinking I could kick it off with a couple of questions, and then we could turn it over to the students. But before we begin, Manish, is there any sort of opening remarks or anything you'd like to mention before we kick things off?
Yeah, so I'm hoping that we can change the format a little bit. Anuroop, I hope you don't mind me kind of, messing with your well-planned agenda. But maybe I could ask the questions. We could switch it after you do a couple of questions. Could I ask some questions?
Okay.
And then we can go from there. I just got, I did so many webcasts where I get asked questions. I decided I want to ask some questions. Is that okay?
That's perfect. Well, why don't we do this? Why don't I kick off with one question, and then we'll give you the floor if that works. And I think I told Manish that this year's criteria for the pitch competition is 10 baggers over 10 years, and so I think he's very intrigued to hear some of these thoughts. But so that sounds great. So look, Manish, maybe we can just kick it off. Would love maybe if you could just kick things off by describing your journey as a value investor. And I think it's always really interesting to hear of people's stories and how they've evolved. And in particular, what got you into value investing? What were some of the key points of evolution in your in your career, in your sort of evolution as a value investor? And then sort of most recently, how that sort of tied into I think you recently talked about your focus on growing pies or spawners, as you coined the phrase. And so, how that transition has gotten to you to the 10 to 100 X's or growing pies and spawners, as you like to call it.
Yeah. So Anuroop, anyway, first of all, pleasure and honor to be here. Columbia is hallowed ground, the origins and epicenter of value investing. So I think all of you are, in a wonderful place, probably the best institution on the planet for what subject we are discussing at hand. So I think it's tremendous, and I think it's a very tough program to get into. So congratulations to all of you, and I'm sorry your experience at Columbia has got somewhat mutilated by the virus, but hopefully it still works out okay. But so anyway, it's always fun to speak to Columbia students. I always enjoy that. I think in '94, I was before my kids were born, I was vacationing with my wife in London, and on the way back, we were flying from London to Chicago, and I was just looking for a book to read, and so I picked up one of Peter Lynch's books, I think One Up on Wall Street, and until that point, I may have bought a stock or two here or there, but I really had no understanding of investing or even, knew much about the industry or any of that. So I read Peter's book on the fly and I really enjoyed it. I said, wow, this is really good stuff. And he did so well. And then I looked up and I found he had a second book, I think Beating the Street. And I read that book and I really enjoyed that. And I was ready to read another 50 Peter Lynch books, but I ran out of Peter Lynch books. There were only two. And so I still wanted to kind of pursue this area. And in one of the books, he talked about this guy, Warren Buffett, in very reverential terms. And I had never heard about this guy, Buffett. And I, looked him up, and I was lucky. The first couple of biographies of Buffett had just come out a year or two before that, Lowenstein and such, or Hagstrom, and those, and then the Berkshire letters and such. So that opened up a very big new world for me, and it was really exciting. And I was just, it was kind of like, I think, drinking from a fire hydrant. I was just absorbing as much as I could, and at that time, I didn't even know that there is such a thing as a hedge fund. I didn't know that the hedge fund industry even exists. I was aware that there was a mutual fund industry. And I was somewhat aware about how mutual funds functioned. And so when I read Buffett's approach to investing, a couple of things struck out to me. So one of the things that struck out is that what he was talking about is what I would call the laws of investing. And these laws of investing, from my point of view, are like the laws of physics. It's like gravity works one way. You can't just say, I don't believe in gravity, and it stops working. It still works. And so I felt like these were like the holy grail. They were the laws of investing. But then when I looked at the mutual fund industry and I saw kind of what they were doing, it was diametrically opposed to everything Buffett was talking about. So Buffett was talking about concentrated portfolios. These guys had 200 stocks. He's talking about, buy and hold and understand the business and all that. The mutual funds were like turning over half the portfolio every year. So everything seemed to be, and the results, the mutual fund results reflected them not following the laws of investing. So in 94, I had sold a portion of my business, and after taxes, everything, I had $1 million. First time ever I had cash that I had no use for in my life. And so it was just sitting around. And I felt that I said, nobody is following this guy, Buffett. And I bet if someone followed him, they would do really well. Because the whole world is doing something different. So I said, why don't I take the $1 million I have? And why don't I start to invest it in equities and figure out, because a lot of things Buffett was talking about, he talked about, I'm a better businessman because I'm an investor. I'm a better investor because I'm a businessman. I could understand business. Okay. And I felt like because I could understand business, when I looked at a publicly traded company, I felt like in many cases, or in some cases, I could understand them. And then I could figure out which ones to invest in and then use his frameworks. And that worked really well. I mean, the million became like 13 million in 5 years, and some dumb luck in there. And I said to myself, Mohnish, I knew we could do this, and look, it works, just have to follow the rules and it works. And so that was how things got going. And then in 99, about 5 years later, a bunch of friends asked me to set up a partnership, and then that eventually led to Pabrai funds and so on. So that's how the journey got going. And then I think more recently, last year, because I had so much time to contemplate my navel last year because I wasn't on airplanes, it's always a good idea to contemplate your navel. And so that led to, led me to Nick Sleep's letters. And, if you guys get a chance, Nomad Investment Partnership, Nick Sleep letters, you can ask God Google, he will take you there. And so I read those letters, and it really, I've known Nick Sleep, he's been a friend of mine for, I think, almost 20 years. But Nick himself went through an evolution. So I was surprised when I read the letters in the way he had evolved. And I realized that I was barking up the wrong tree. And I was always in the mode, mainly because I think markets were so euphoric in 99, 2000, they were so overvalued. I went to more classic Graham, buying 50-cent dollar bills and selling them at 90 cents. And I realized when I looked at what Nick was doing that the holy grail was to find long-term compounders and not to sweat it if the company is a little bit overvalued. Basically use the same framework in owning a business as a founder does. And so that's a pretty significant shift. But it makes life really easy because, you don't really have to sweat the valuation so much. You don't need to put a fine, exact number on it and so on. And you're generally wanting to, as long as the business is not in secular decline, you're generally, letting them ride. And of course, there are tax efficiencies that come with that as well. So that's a relatively new journey that I'm on, and it's exciting. And so we'll see how it goes. So that's sort of been what's been going on.
Great. And maybe Mish, maybe just my second one, and then I'll turn it over to you to ask the questions. But I would love to just sort of understand how you have in the downturn investor, you talk a lot about the concept of heads I win, tails I don't lose a lot. And in terms of margin of error, I would love to just maybe delve into examples of how you thought about sort of margin of error, because I think it's a really interesting concept. And then also in context of thinking about spawners or growing businesses, I think if you give an example, they tend to be smaller and maybe a wider range of outcomes for these businesses. And so how you sort of, think about margin of error in context of, the spawners or these, the businesses you're now focused on.
Yeah, I mean, I think, Buffett says the focus really should be on the downside. So you really have to make sure that the downside is very solidly protected. And if the downside is well protected, the upside almost takes care of itself. When I wrote the Thandu Investor and I wrote about the Patels, I mean, my own experience as an entrepreneur, and this is not just my experience, it's the experience of almost all non-venture-backed startups. So venture-backed startups make up maybe 1/10 or 1% of all startups, maybe less than that. Non-venture-backed startups is what is everything that drives the US economy, the non-venture-backed startups. And so the people who start these businesses, everyone thinks they're risk takers, but they're the opposite of risk takers. Entrepreneurs do not take risk. They do everything in their power to minimize risk. And so they try to put the odds as much in their favor when they take these bets. So, for example, in my own case, when I started my business, I pulled $30,000 from my 401k account, and I was 24 years old. I wasn't worried about my retirement savings at that point. And I took $70,000 in credit card debt, and I researched personal bankruptcy laws at the time. They've changed those laws since then. But at that time, if you declared bankruptcy, personal bankruptcy, pretty much everything was cleansed, and you couldn't declare bankruptcy again for 7 years, which actually meant that you became a better credit for people to give you credit cards and such, because they knew you couldn't screw them again. They knew they got screwed once, but they knew they couldn't get screwed a second time for at least 7 years. So your credit improved. So the way I looked at it, I said, okay, this 100,000 that I'm putting in, let's say it blows up. Let's say the business fails, right? So I say the 70,000 is Visa and MasterCard are my venture capitalists, okay? And they are just great venture capitalists. They took no board seats. They never asked me what I'm doing. It just was beautiful. And if it didn't work, I could just go and declare personal bankruptcy and it'd be just wiped clean. And the 401k, I'd get a job and we'd rebuild that. So, and I was single at the time. And when I left my job, my boss told me, we would love to have you back if you come back. They told me, when your business fails. They didn't say if your business fails. They told me, Mohnish, when your business fails, you can come back. We'll give you like a 20% raise. We'll give you a promotion and you'll be all set. We'll be happy to have you back. So I said, this is great. Okay, the business fails. I declare bankruptcy. I go back to work. I have a better pay. So where is the risk, right? So this is how the brains of most early stage entrepreneurs, which are non-venture backed, work. Venture backed guys, they got an IV drip. They're a different universe. Forget about that. So IV drips are really bad for you because, it's better to spend your time getting customers than trying to get some VC to fund you. I always feel it's better to just get customers. So anyway, what I'm trying to say is that early stage businesses, most early stage businesses and the entrepreneurs who start them do not take risk. They do everything in their power to minimize risk. And of course, what happened with me was the business never failed. I never went back to work. I paid Visa and MasterCard off. They got very lucrative, interest terms. Everyone is happy, no problems. So I think the same framework comes across in investing, because just like as an entrepreneur, you try to minimize downside risk. The same thing in investing. You should always look at what happens if things don't go the way you're thinking. What's the protection? Because, capitalism is brutal. It's creative destruction. Most businesses that get started won't make it. Even if they make it, they won't go 10 years or 20 years. And by the time a business enters the S&P 500, it is already past its prime. So it's already the elements which will lead to its decline are mostly already in place. And very few businesses last 50 years. Almost no businesses last 100 years. So it's pretty hard.
Great. Manish, I know this is probably a ton of questions, but why don't we kick it off with questions you have, and then at this time we can go and go with some of the questions the students have.
So there are 25 teams in the class, which is great. We have the purging contest coming up in a couple of weeks, and most of you have your 10x and 10-year ideas already in your heads. You may not have your pitches ready, but you at least have the ideas. I am desperate. I'm desperate for those ideas. So if you would please share with me the names of your ideas and maybe 3 sentences, which you would give to an 8-year-old, of why it's going to kick ass. And we're not going to post this video till at least May. So none of this is going to be, this is just between us girls. Okay. Just purely between us girls conversation. So basically, whoever wants to go first, second, whatever, I am all ears.
All right. Well, we've been coaching them on the 60-second pitch. So this might be a good time to use to put that into practice if we have some brave volunteers. So I guess if there's any brave volunteers who want to, we can just go by the raise the hand feature, and I can call them out if there is anyone who wants to take a stab at it with their company of choice. We got one volunteer for me, Bill Dudley. Do you want to give us your 60-second pitch?
Yeah, sure. Mohnish, thanks so much for coming today. Really appreciate it. So my team is Connor, Flood, and Joyce Sang. We're pitching Boyd Group Services. They are a roll-up of auto collision and glass repair services. They have about 3% share of a very large market, good returns, and a strong balance sheet and cash flow to continue rolling up.
What's the name of the business again? I'm sorry, I didn't get the name.
Boyd Group Services.
Boyd Group Services, okay.
It trades on the Toronto Exchange. BYD is the ticker.
Okay. And what's the market cap?
It's about 5 billion CAD, so it's like 4 and change US.
So is it going to 50 billion?
No, but I think it can go probably to 20 billion over time.
All right, pretty good. I'm appreciative of the idea. And were there any others that came close that you looked at and then discarded?
Yeah, we had a bunch of ideas. Connor and Joyce, feel free to hop in. I think we looked at Vail. for a while. We looked at Snowflake. We looked at GraphTech, which I think you own or owned at one point. Guys, am I missing anything else? I guess not. Yeah, those are the only ones we looked at.
Okay, well, I appreciate that, Bill. Thank you very much.
Yeah. Cheers.
Anyone else?
We have Dixon.
Hi, Mohnish. Thank you so much for spending time with us. My team is working on NG. It's recently rebranded to NG Incorporated. It's the largest online marketplace for home services in the US, multiple the size of the closest competitors, and it's undergoing a business model change from a traditional lead generation model to a fixed price, pre-price model, which we believe will significantly increase the tick rate and improve the margins going forward. And it's still a very underpenetrated market right now, so there's a lot of room for growth.
What's the market cap?
Right now, it's around 8 billion.
I'm sorry, 8 billion? Yeah. Okay. And so is it going to 80 billion?
We think there is it's within possibility within the next decade.
Okay. And were there any other ideas that came close?
Not really, to be honest. Well, we didn't spend too much time on other ideas. And this is it's controlled by IAC, I should mention.
Oh, so it's one of the IAC businesses.
Correct. It's the main IAC business right now. They still own 84% of the business.
Okay, and what's the ticker again?
ANGI.
Oh, this is so it's Angie's List. That's right. Okay. Yeah, I'm sorry, I didn't get that.
On Angie's List, yeah.
Yeah. That's I use Yelp services a lot, so I appreciate the business model.
Okay.
So it's great. Thank you. Next.
We have two more volunteers, or three more, I guess. Shirag.
Hi, Mohnish. So our team is researching and working on Copart. So Copart is a online B2B bidding platform for the car salvage auction market. So basically, you have car sellers on the seller side, which are insurance companies and car fleet owners and used car dealers, and on the buyer side, you have whole sort of car rebuilders, dismantlers, and used car dealers in the emerging markets. And so what we feel is that Copart's differentiated business model and its superior execution skills, they've kind of enabled it to gain market share in a duopolistic market. So they kind of control almost 40-45% market share in the US. And the other second player is also around 40% of the market. And we feel that Copart is well positioned to kind of further expand its market share in its core business segment, which is the insurance segment, and then also expand its presence in the non-insurance segment and kind of further strengthen its positioning in the international source markets of UK and Germany, which are the largest car markets outside of the US. And just like very quickly, why we feel it's a high quality business is because of its superior track record of capital allocation, average return on equity of around 30% plus, free cash flow margins of 10%, has grown at almost 11% over the last 6 years in terms of top line and 26% in terms of the bottom line. And we feel that at its current valuation, you are essentially getting the international business for free.
And so, did you read the biography of
Yes.
What was the name of that book? I forget the name.
From Junk to Gold.
Yeah, so I really enjoyed that book.
Yeah.
It's a very good book, and I think it's a great business. And in fact, one of my investors in one of my funds, actually a former investor now, he's pretty high up in IT for them. He's a very smart guy, actually, in Texas. And I actually looked at the business, but what's the current market cap?
It's around $25 billion.
And what do you think the market cap is in 10 years?
Around $90 to $100 billion.
So how are we getting to 250 billion? Mr. Ackman is not going to be happy with 3 or 4x.
So this is according to our base case. We're still building the best case scenarios. I think this is a very conservative, again assuming all sorts of margins of safeties. I think this is at least in any case you should make this much return, and definitely to the best case scenario there are going to be a lot of other things that we need to underwrite, which we're still working on.
Yeah, actually, one thing. I really like the Copart business. I think it's an exceptional business, and also they have one of the tailwinds they have is that these cars now have so many sensors in the bumpers and all that. So small dings lead to salvage.
Yes.
A car is 5-6 years old and there's a minor damage. It costs more than what the car is worth. And so it's going in the direction of Copart. And I think just, in the book, the company has some very good principles, and so I really like it. So thank you for sharing that. Were there any other businesses that came close for you guys?
I mean, I would request Tushar and Athena to share, because I think this one was from my side, but they had some interesting names as well.
Okay.
Tushar or Athena, if you want to share your picks that we discussed.
We also looked at Viva, the healthcare SaaS system, but we felt like the market understands their growth pretty well. Tushar had a paper company that he had in mind. Where is Tushar?
Yeah, no, I was proposing a packaging company, and the business didn't seem as strong as Copart when we spent more time on Copart, so we dropped that.
Okay. Thank you for sharing. Who's next?
Okay, Manish, we got 2 more volunteers, and at the end I can send you the list of the 25, so you have all 25 pitches. So you'll have that in your inbox.
We'll do 2 more, and then we'll go to questions. How's that?
All right. Oh, yeah. No worries. Oh, we might have a couple more. So maybe we get 4. I just saw a couple more hands raised. Okay, so we'll go to Frank, and then we'll go to Noah.
Sure. Thanks for coming. So this is Frank. We're pitching a stock called Ollies. The ticker is OLLI, listed on NASDAQ. It's a $6 billion market cap company. It's a discount retailer, and basically what it does is it buys closeout deals. So from bankruptcies or canceled orders, from Walmart, those kind of things, they buy those at a significant discount, and then put it in the store and sell it at customers at very significant discounts as well. So the company currently has over 300 stores. It's seen very consistent 15% of CAGR in the store count over the past 10 years. We think the momentum is very good. It could easily grow to 1,000 stores, maybe 2,000 stores. So we do see solid business here and white moat, and we like the business.
What did you say the symbol was?
OLLI.
Oh, Ollie's Bargain. I've never seen their stores around. Where are most of their stores located?
They are mostly in suburbs, like the strip mall.
Are they in California?
They're not in California. They are mostly still on the East Coast, and also they've recently expanded to Texas. And we believe one day they will reach the West Coast. So that's why there's a lot of white space. And
so are they doing clothing, or what type of merchandise?
Not typically. Basically the home good stuff, like the basic stuff, small electronics, and I guess a pretty broad range, but mostly necessities for your living, toilet paper, stuff like that.
Okay, and so basically so who would be their competitor?
There are a number of competitors, maybe you could say dollar stores, but dollar stores, they will be not branded names. They will sell branded merchandise, but as a significant discount. And some of their competitors might be Big Lots, if you've heard of it, and Tuesday Morning, those kind of. But they all have their own problems. But Ollies is seeing very great momentum right
now. And one thing that's interesting to me is that I think I've written about, in my first book, I wrote about that funeral services is a great business.
Oh.
And Ollies is in the funeral services business.
Funeral service?
Yeah, you may not have thought about it that way. But the thing is that, for example, if you look at TJ Maxx, for example.
Uh-huh. Yeah, it's sort of like TJ Maxx. But
so
they don't sell clothes.
So businesses that are either in recycling or funeral services are very good businesses. So Ollies is you might say it's recycling. Maybe funeral services might be a little extreme.
That sort of makes sense.
But generally those businesses have very strong characteristics because they have it's very compelling for a customer. The second thing is they may have a little bit of a Costco aspect to them, in the sense that when you go into their stores, different times when you go in, there's different inventory. So there's a little bit of a bazaar type situation
Exactly.
where you get surprised, right?
Yeah.
They might have some big, inventory of big TVs come in or something.
Yeah, that's exactly what happens. They call it treasure hunt. So,
Yeah, the treasure hunt, right?
Yeah.
So those businesses can be pretty good, but also that, they have to execute and scale.
Yeah.
And one of the things about scaling is that unlike Costco, you got to keep feeding the machine, right? Like TJ Maxx has to keep feeding the machine.
Yeah.
So that might get more difficult as things go on. But
but they have a spectacular buyers team. They've done very good. We've just done calls with experts. Everybody's sort of there's more than enough than they could buy. So buying has been going so far so good for them.
All right. Well, thank you for sharing, Frank.
Thank you.
All right. Who's next?
All right, Manish. We have three more, and then we'll flip it and get the students to ask you some questions. If that sounds good. So we have Sagar. Noah up next, and then we'll go to Sagar.
Yeah. Hey, Mohnish. Thanks for being here. So my team, we are pitching Danimer Scientific, which is the only commercial manufacturer of marine biodegradable plastic resin. So their product, say a chip bag, would degrade in the ocean in 12 weeks without leaving any synthetic material behind.
Wow.
And they're solving the massive plastics waste problem. They're sold out with take-or-pay contracts from blue chip customers through planned 2024 capacity. And they're protected by significant R&D moats and a first mover advantage. And we believe they could build new facilities at over a 20% ROIC and use cheap project financing. The business currently trades at about a $4 billion market cap, and we have a base case MOIC of 8 times in 10 years.
Okay, and then what's the ticker symbol?
DNMR.
DNMR.
Yep.
All right, and did any other businesses come close or?
So the nearest competitor is a company called RWDC, and it was actually founded by the Dan in Danimer. He left about 6 years ago. So clearly a lot of the IP here sits in his brain, but these guys are barely scratching the surface on the addressable market.
Okay, thank you for sharing. Next.
Thanks, Noah. Sorry, go ahead, Manish.
Hey, this is Sagar. Kedar, Neil, and I are pitching Vroom, ticker VRM. It's a $5 billion market cap, $1.3 billion revenue, used car e-commerce platform in United States. The company went public recently in June 2020 and is trading at a relatively cheaper consumer tech multiple of 1.7x price by revenue. The company represents a great opportunity where it is trying to streamline and nationalize the used car inventory marketplace model. Currently, the US used car marketplace is a $800 billion industry, which is highly fragmented, filled up with largely mom and pop stores. And Vroom is trying to consolidate the market. Currently, online e-commerce players represent only 0.5% of the overall market. And as this post-COVID inflection where consumers are becoming more adept at buying used cars online kicks in, this e-commerce penetration is expected to go up as high as 50% in best case, and in base case, maybe 20 to 30%. We believe that Vroom could sell potentially more than 1 million cars by 2032. And with an ARPU of close to $20,000 US, it represents a 10x in 10 years.
And do they compete with Carvana?
They do. They have different models. So Carvana does like a traditional used car model where it goes region by region, versus Vroom, which is trying to truly bring the e-commerce efficiencies by going national and then redistributing its inventory basis data observed in each market.
Okay, and why has the stock behaved differently from Carvana?
Yeah, so recently, Vroom is relatively more risk averse. So during COVID, it brought down its inventory from up to 8,000 cars that it had in June 2020 pre-IPO to almost 2,000 cars because it couldn't predict how quick the market would rebound. And unfortunately for them, the market rebounded quite positively and they were left with lower inventory, lower number of online posting of cars. And that's why their sales kind of took a dip compared to what the analysts were projecting, and that made the market a bit apprehensive.
Okay, well, thank you for sharing. Anyone else, Anuroop, or are we done?
Let's sorry, as a mute. Let's do one more, Manish. Maria, do you want to I guess finish us off on the pitches?
Sounds good, Anuroop. And Manish, thanks so much for being here. I'm on a team with Maggie and Daniela in this class. We're pitching a company called PagerDuty, which trades under the ticker PD, which currently has a $3 billion market cap. PagerDuty provides incident management and response solutions to customers across a variety of industries. So, for example, if you're an online retailer and your website goes down, PagerDuty is going to alert the correct members of your IT teams and help provide intelligence to both troubleshoot and prevent that sort of problem from occurring in the future. So we believe that PagerDuty has a first mover advantage in the space and is going to benefit from the tailwind of the increasing importance of the virtual and digital space for customers, generating a larger and larger share of their revenues over time.
Okay, and what are the revenues of the company?
Sure. So Maggie and Danielle, I believe, and I have worked on the model. So the company has actually experienced a pretty significant revenue CAGR over the past 5 years to about 40 million. So pretty significant growth in the past 5 years to, I believe, about 200 million today.
Okay, well, thank you for sharing.
Thank you very much.
You know, one question I had, Anuroop, is that I didn't hear any pitches that were less than 100 million or less than 200 or 300 million. Was there a minimum market cap in the contest or no?
Yeah, so the minimum market cap, I think to your point, I think it was $1 billion. So that was the criteria, sort of $1 billion plus market cap, North America listed with the two criteria with 7 to 10x potential over 10 years.
Both those rules took away all the fun.
I think maybe Bill was just going to potentially source those funds, so he needed a minimum size for the business. But definitely the 10 bag has become easier if you can go sub $1 billion for sure.
Yeah, so because I was just wondering, because I felt that it's definitely harder as you get into the billions.
For sure.
The pickings become slimmer, but on the other hand, you pick some 5 billion market cap, may not be fair and may trade by appointment, So that might be an issue. So, but no, it's wonderful to hear the pitches. And of course, one of the issues I go through as an investor is, the first thing that goes through my head is this within circle of competence, right? I mean, it's the first thing I'm processing. And probably 99% of stuff is outside my circle of competence. So a lot of the pitches actually are just straight over my head. They're way past my pay grade. So they become hard until I spend more time and try to figure them out. But it's great to see the diversity. There's a wide range of businesses. And I think the Pershing contest is really, really cool because it just drives things in a very practical way. So that's wonderful. So would you like to switch back to me answering questions?
I mean, it's open-ended, but if that works, we can switch it back and
so
maybe go to some of the student questions.
Let's see what you guys have on your mind. Sure.
All right. Okay. So if everyone just wants to, whoever has questions, just raise your hand, and then we'll just go through a list for as much time we have. I see Maria has your hand still up. Is that from before, or did you have a question to kick us off?
That's been before, but I can kick us off as well. So Manish, I was curious, been reading a lot about your different definitions, and one that was particularly interesting to me was this idea of the Uber Cannibals and that kind of constant rebalancing every year, looking at Uber Cannibals. Was curious to what led you to develop that newer definition and what you think of the prospects of that in the medium to long term.
Yeah, so I think the Cannibals is a term coined by Charlie Munger as it relates to buybacks and such. And Uber I borrowed from the ride-sharing company to add a prefix to it. But basically the idea is that if a business has a lot of stability in its operations, where there's going to be some sort of high probabilities of continued prosperity and cash flows. And it's, not ridiculously priced. It can be a really good use of capital. And we've seen some examples. I think two good examples are NVR and AutoZone. So NVR over, I think, 25 years or something has bought back like 80% of their shares. And their business hasn't grown much, but the stock has gone up, I think, more than 400-fold in the last 25 years. And it's a home builder. It's not some tech company or something like that. But they are very capital light, and they pretty much they have religion where pretty much they take 100% of net income and sometimes more than 100% of net income and dump it all into buybacks. And they also don't try to time the market or try to figure out if the stock price too low or too high or whatever. They just autopilot buying back shares. And it's worked out very well for them and their shareholders. And the same with AutoZone. It's an okay business, but I think the buybacks have really contributed. So I think that if certain businesses with certain characteristics sign on to these types of programs and they go long term, I think it can do very well. One of the things I learned in terms of the Uber Cannibals is rebalancing them every year is not a good idea. What we really want to do, we want to find the future NVRs. And you really cannot get a hockey stick at some point where you just keep buying back the shares and then at some point the multiple takes off and everything takes off. So it can be really good if you can identify company DNA that, buys into that and is going down that path. It can be really good.
Great. Next we'll go to Dixon.
Thank you, Professor. Hi, Mohnish, it's me again. I have a question. So you just now you mentioned that you were more focused on the downside as an investor, but I think you admitted also in the recent podcast you did with Professor Santos that you have a tendency to go into situations where the outcome could be binary because of high leverage and maybe a turnaround situation. So can you just maybe share with us why so and how are you navigating away from them? And for example, the experience with Horsehead, for instance. And with those experiences, how do you think about averaging down right now?
Well, so I never deliberately go into situations that are binary outcomes. I mean, those are not appealing to me. Sometimes I end up in situations where eventually it becomes a binary outcome or it's gone south. So that's a different situation. But I do try hard at the outset, before the investment is made, to try to figure out what could go wrong. And if those things go wrong, what could happen to our investment results with the position. And generally speaking, we try to not go into situations so investing is probabilities. I think any business has some probability of a zero. It could be very small, but it's not non-existent. So every business has uncertainty in the future and could have serious difficulties in the future, which may not be predictable. So we can't just say that something is an absolute. Investing is a game of probabilities. What we do want to do is we want to try to maximize the probabilities of a good home run and minimize the probabilities that we have a permanent loss of capital. So if things don't work and I end up with approximately what I started with, that's a great outcome. I would take that bet all day long. And if things do work, then I get a multi-bagger. So if that's the kind of equation I'm looking at, then that equation is very attractive. If the equation is that there's a significant probability of a zero, coupled with a very high also probability of a multi-bagger, that's not of that much interest. So we definitely want to have downside protection. Sometimes we end up in situations, Horsehead is an example. at the time the investment was made, it wasn't a risky investment. What ended up happening is that they were trying to build a new plant, which continuously kept getting delayed and had cost overruns. In the meantime, they had shut down their old plant. And in the end, they ran out of runway, where the zinc prices collapsed and all their financials went upside down. So it's definitely within a bell curve of probabilities, but I did not expect it to go to that extreme end of a bell curve. But we learn, so one of the things I learned from that experience is that you just cannot assume that when managements embark on these, ambitious new plants and things like that they will go as planned. You have to put in a margin of safety. I have another investment right now, for example, a company in India called Rain Industries, which has again been building some new plants and such. And they've had some cost overruns and some delays. But it has not impacted the business because the size of those investments relative to the mothership is well understood. And even if those plants if it was zero in those plants, for example, the business would not get affected. Business would still survive and thrive. And so that was missing in the horse-head situation. The what if this doesn't work at all? So we live and learn. And so that was a good learning that came out of that.
Thank you.
Great. Next up, we'll go to Joseph Zhang.
Thank you, Professor. Thank you, Mohnish. So I'm actually from the same team with Frank, which is the Ollies bargain outlets team. So I think you actually just mentioned that Ollies' business model is kind of like a funeral service. I really didn't, get this point. So maybe could you elaborate on this comment a little bit more?
Yeah. So for example, if you look at Ollies, for example, let's say some manufacturer has 1 million too many flat screen TVs they made, right? And they need to get rid of them. Ollies is the burial ground for those TVs. They're going to give those TVs an honorable burial. And actually, not really a burial, they're going to give them an honorable recycling, So basically, the thing is that everything that is living and breathing today will die, right? And all kinds of manufacturers will always have issues with too much inventory or unwanted inventory, or, Costco just returned a huge bunch of stuff and so on. So that this need to recycle and find those somewhat damaged goods a new home is a continuous need. So funeral services, let me take a step back. My book, the first book which talked about funeral services, is out of print. But if you go on my blog, Chai with Pabrai, all the chapters are there as PDFs, and they're the chapter on the funeral business. So if you look at traditional funeral services business, they're really good businesses because, number one, none of you will tell me that after Columbia Business School, I'm going to run a funeral home. That is not what you aspire to do. Most 20-somethings don't say, I'm going to be the tycoon of funeral homes. Okay. So people don't aspire to enter the business. Okay. The second is that when your grandmother dies and you're looking for funeral services, I hope you don't take the low bid. Okay. You don't call 10 places. Now, she may not have been that great a person, but even then, you won't call 10 places and find the cheapest place. I hope you won't do that. So you're typically going to try to go to a place which your family has used in the past. There's some kind of connection, whatever, or, which is got, and you typically don't negotiate bottom of the barrel services. If they tell you, would you like flowers at the service, you're not going to say no. Okay. So generally speaking, the business, when they're selling their service, they don't have pricing pressure. Okay. And the second thing is, I don't know who's going to die in Peoria in 2022, but I know how many are going to die in Peoria, Illinois in 2022. Okay, so there's a recurring revenue to funeral services, which is beautiful. So all of these things actually make models like TJ Maxx really, really good models, because so some examples of either sort of recycling / funeral services businesses are eBay, for example. eBay is recycling and funeral services. It's a great business. TJ Maxx is a great business. And you can just go down the list, Ollies, their competitors, Big Lots. All of these guys are great businesses because these mismatched inventories need a home. And I mean, when I look at, I have an investment in Seritage, right? They are converting the Sears into other things. One of their tenants is TJ Maxx. No issues with the business, very strong financials, great tenant because of the underlying nature of the business. Retail is a terrible business, but within retail, recycling and funeral is a great business. So it's a good area to look at.
Thank you so much.
Okay.
That's a really, really interesting way to think about it. We'll jump over to now.
Yeah. Hi, Mohnish. Thank you for coming and talking with us today. I first got to know you 5 or 6 years ago when I was reading Guy Spear's book, The Education of Value Investor. And you and Guy jointly bought a ticket to have lunch with Buffett, right? So I'm curious to ask, how was the experience? How is your relationship with Guy today? And in general, how do you get along with other investors?
My relationship with Guy is awesome. In fact, this morning, he called me and then he was showing me he's hanging out in Klosters in Switzerland, which is near Davos. And he just bought a home there and he was just showing me the view, which is spectacular. It was really good. The lunch with Buffett, when I told my wife that I wanted to bid for this lunch, she, has seen a lot of quirks in me over the years and she just thought it was just another stupid quirk. And she said, whatever. And then after the lunch and since then, she said that other than marrying me, it was the best thing you ever did. So that lunch, and I did not have this planned, that lunch is continuing to pay dividends endlessly. Okay, it's actually tremendous because one of the things that happened at the lunch is I told Warren at the lunch, I said, look, Warren, my wife Harina is a great fan of yours, but her true love in life is Charlie. Okay, and he's very competitive. So he said, he tells her, listen, Charlie is just this old fart. He's very, very boring. Okay, I am the guy who's interesting. Okay, not him. Okay, so he said, now to prove to you that I'm the real thing and Charlie is useless, I'm going to set you guys to have lunch with Charlie. Okay, and now you can bribe Warren and have lunch with him, but there's no such bribing mechanism with Charlie. Okay, so I just thought Warren was kind of joking. Okay, then 3 days after the lunch, I get an email from Buffett's assistant going to Munger's assistant saying, hey, I met these guys in California, wonderful couple, blah, blah, blah. And they seem to have the misconception, Charlie, that you are more interesting than me. Of course, they're wrong, but I've told them to meet you for lunch and then they'll, have their head screwed on straight after that. Then, we had lunch with Charlie. So it was like buy one, get one free. Okay, it was great. Okay. And of course, I ended up enjoying the Charlie lunch a lot more than the Buffett lunch. Charlie is unplugged. Okay, it's always unplugged. He's going, and if you think he's unplugged in the daily journal meetings or the Berkshire meetings, you have not seen him one-on-one. One-on-one is completely unplugged. He would say something and I would just turn and say, did God just use that word? Did God just say that? Yes, I think. And then while I'm thinking about that, God says that word again. Okay, so it's really funny. But anyway, so what ended up happening is um, Charlie and I ended up becoming friends. We ended up becoming, I played a lot of bridge with him and his friends at the LA Country Club, which was a lot of fun because, Rick Goran passed away. But Rick Goran and Charlie and a couple other guys used to come for bridge. And we used to meet for lunch before the bridge game. So I'd be sitting there and there'd be Charlie and Rick in front of me. Okay. And I'm like pinching myself saying, is this real? What's going on? And then I would ask them all these questions about the 60s and, the Western Pacific Stock Exchange and all these things that they were doing and all these different stories they had. It was just hilarious stories, So anyway, the thing is that lunch has led to, probably several dinners a year with Charlie in his home, a lot of bridge games. And then on the Warren side, that friendship also continues. I got to know Warren's assistant really well because we were setting up the lunch and all that. Debbie's wonderful. And Guy and I told Debbie, listen, can we take you to lunch? And she said, look, if you come to Omaha on Thursday, when the meeting's on Saturday, because Friday is crazy, Thursday we can go for lunch. So for several years, Guy and I used to show up in Omaha on Thursday, and then we'd go to lunch with Debbie. Okay. The lunch with Debbie or the lunches with Debbie were 10x better than the lunch with Warren. Okay. Because I would get all this, like I would say, all these stories, like, for example, the Wall Street Journal usually is printed very early. Like it's, I think by 2 a.m. or 3 a.m. it's printed. And Warren had figured out some way of getting the paper, not at 7 a.m., but like, if he was up late, he would get it almost the night before. And then, just the way, I got a lot of details and like, I used to ask Debbie, this was like going back maybe 10 years. I said, Debbie, does he have a mobile phone? So she starts laughing. So she says, he has a mobile phone. It's usually sitting in my desk. Okay. And she said that when he goes out of town, I charge it and I give it to him. Okay. And he says she told me the only thing he knows how to do with it is to call me. Okay. So he says, anytime he has to use it, he calls me and says, have such and such guy call me. And then he knows how to answer the phone. And that was it. Okay. That was the extent. And Charlie has never used a mobile phone in his life. Okay. So here's, some of the biggest Apple shareholders. And that's the situation with mobile phones. But anyway, I got a lot of, interesting data about how Warren functions. And also, of course, since the lunch, met him many, many more times. And one time he gave Guy and me a tour of his galactic headquarters. And so he takes us to the Coke machine. He says, this is my Coke fountain. And then, he pours himself a Coke. So anyway, what I would just say is that I just wanted to have lunch with him to thank him. I had no ulterior motive other than to just be able to face thank him. But what ended up happening was there was just all this other stuff. And, there's a meeting on Sunday in Omaha for the managers, all the Berkshire managers and the board members and all that. And Warren invites Guy and me to that Sunday brunch. Okay. And every year, Guy and I think that this is it. We're not going to get any more invitations. We've been getting invitations for like 10 years because sometimes we'd be at that brunch and I'm sitting with Guy and right behind us, Bill Gates and Bono are talking to each other. Okay. So it'd be just all these surreal things going on. Or, that NFL player, with the long first name and last name, Sue, Nagamadum, Sue, whatever his name is, I can't even pronounce it. He'd be hanging out. And then I'd see he's like the gentlest creature. I look at him and say, you could never harm anyone. He said, yeah, that's how I am normally, except on Sundays, So anyway, it was just been wonderful and it continues, That lunch took place now, I think, 13 years ago, but it continues. So it's been great, wonderful, nothing to regret.
Yeah, amazing. Thanks for sharing the story. Thank you.
All right. Anuroop,
Yeah.
we've gone past time, but I have no pressing engagements. So we can go as long as you guys want to go.
Okay. Why don't we
Whenever
say
you
we
want
go
to
to
shut
about
off, we can
5:30?
shut off.
Okay, perfect. Do you want to say we go to about 5:30? Does that work for you, Manish?
Yes, that sounds good.
I guess 5:30 Eastern, so probably 2:30 your time. So not 5:30 your time. No, no, those are really interesting stories. I'm sure it'd be great to be a fly on the wall, particularly for to hear Charlie unfiltered, which I guess most people think is unfiltered even in the public audience. So I guess next we'll go to Shirag, which I think you may have heard from him already in one of the pitches.
Yeah, hi, Manish. That was a very fun conversation. So I'm not sure I should be asking this theoretical question now. But my question is more around margin of safety, and that's a term that's widely used across the investor community, right? And different investors kind of have a very different thought process around it. Like for some, it's more about being able to buy at a good discount to their belief of intrinsic value. For some, it's about buying a high quality business, even if that's a fair price, because for them the safety net is around the quality and the quality of the management team. And even on the valuation side, some want to apply conservatism across all parameters, be it valuation, be it projections, be it the market opportunity, whereas some want to get the business and the market more accurately and want to just use this lever on the valuation side. So just wanted to get your perspective and your experience, and during your evolution as an investor, which of these levers do you kind of spend more time on or prioritize, and which ones which levers you don't care much about and try not getting caught up in that analysis paralysis cycle?
Yeah, so I think that if you looked at Ben Graham and all of what he was talking about, he relied on hard asset downside protection, right? And part of the reason he relied on hard asset downside protection is because he came out of all the turmoil of the Great Depression and all that, the 1930s with the stock prices and doing what they were doing. And he saw all the decimation of wealth that took place at that time, right? And so in many ways, you could say that Ben was scarred from that experience. And so what came out, security analysis that came out from that experience was very much, we are going to invest in a manner where no matter what happens, we cannot lose money. Okay. The problem with that approach is it also crimps your upside. So if you buy some crappy business that is trading at 1/3 of liquidation value, probably it doesn't have much upside either. That's the nature of the beast, right? And so Warren actually evolved from there. And the big evolution for them came when they saw what happened with See's Candy, right? And so the See's Candy experience, because he paid more than $25 million for book value of less than $5 million, right? He was paying several times book value, which to him was a big step in a different direction. But the See's investment led them to make the Coca-Cola investment. And when they made the Coca-Cola investment, again, it was the same thing. The downside protection was not hard assets. The downside protection was the brand and all the embedded memories we all have of Coke deep in our psyche. So even when he made the investment in Apple, the downside was not in the hard assets. It was in the brand value and what link customers had to that company. So I think and the other thing is something Munger pointed out is that Ben Graham always focused on all these net nets and downside protection. He made all his money on Geico. And he made money on Geico not because he bought it cheap. He made money because it was a great business. And so when we look at margin of safety, I think we have to be a little more flexible, because typically you're not going to get all of the above. You're not going to get heavy downside protection in terms of hard assets, where even in worst case times you'll come out ahead and at the same time have 100 bagger potential. So the two generally will not go hand in hand. It may happen once in a while, but it will typically not happen all the time. And so I think we need to look at downside protection. We need to be comfortable that the downside may not be protected purely with hard assets. And we may even go to the point of saying that if things don't work out, we may have a problem, but the odds of that are really low. So when you look at businesses like, you look at Copart or any of these other kinds of businesses, you can't really get to downside protected with hard assets. But a combination of the culture, the values, what the reputation means in customers' minds, the links with the insurance companies and the links with their all the other ecosystem, that's what's giving you the protection. And so you need to get comfortable with that.
Got it. No, that's helpful. Thanks for sharing that.
Sure.
Thanks, Chirag. Sean?
Yeah, could you maybe elaborate on your thought process when you were thinking that it was okay to, break your 401k, just because of the tax penalty that you had to pay, as well as, the credit card, obviously APR is really high. So were you already thinking that you're going to be able to generate, superior returns above that, 25% APR rate? Or, and like second question is like, the question kind of popped up as soon as you were talking about the brands, but like Twinkie brand was obviously a strong brand, but that brand got, the company went bankrupt. So just would love to know what was made that more of an exception, and like what characteristics that enabled that.
Well, so first of all, about the 401k and the credit card. So at the time, I was 24 years old. I was single, and as far as I knew, I had no kids. Okay. So basically, the thing is that there was, I knew I had one clear shot, okay, where I could completely fail and nobody really would get affected. And my biggest asset was my future earning potential, which was I was not mortgaging my future earning potential. So I knew that I could always get another job, and I had a long runway that I could work for a company or whatever else and get paid well. So what I was putting at risk was really not the 100,000 I borrowed, because the 70,000 could get written off with a bankruptcy and so on. It was really the 30,000, right? And so the 30,000, my take was, if it goes away, it's not the end of the world, because I can restart and get back those savings and so on. So I didn't really, but what I could see on the other side was that I would have at least felt that I gave it a solid shot, right? If I just stayed in corporate America and just didn't do that, then I would always be wondering. And as I got older, or if I got married and had kids and all that, the equation changes. Everything changes then, because then the risk factors become higher. I used to at that time have a Subway sandwich for lunch and a Subway sandwich for dinner. And my lunch and dinner together was $7. Okay. So I had no expenses. And, so things were pretty, and I was happy. I was very happy having a Subway sandwich for lunch and dinner, because I was so excited about the work that I was doing and the things I was trying to build and all of that. So I realized the interest rate was high, and I realized the 401k, I'm going to pay penalty and all that. But I just said, you got to do what you can do with what resources you have. And I didn't see much risk in just blowing those up. So that's why I went for it.
Yeah, and I think it's, you talk about this in the book, but I think people tend to confuse risk and uncertainty a lot, right. And it's a very common thing people confuse in investing. And I think it's such an important distinction, but it's one that a lot of people sort of intermix.
The other thing, your question on brands, 98% or 99% of businesses are not going to get to the promised land. So capitalism is very brutal. If we just went through the list of companies that you guys gave me, and we just 10 years from now looked at that list, one of the things that will be there in that list will be a high mortality rate. Not just that they didn't get to 5x, that they're not even where they are today. They've gone backwards. And of course, I don't know which ones. We wish we knew which ones. So I think that capitalism is very brutal. Just because you have a great brand doesn't mean you're going to get there. A lot of great brands perish. Brands need a lot of care and attention and nurturing to get to where they are or where they should be. And if they go through neglect, even for a short period of time, it can have a very detrimental impact. So businesses are very fragile creations. And that's why what we want to try and do, we want to look for the exceptional business that is not so fragile. And then once you find the not so fragile business, then you've also got to find them at a cheaper price and all these other pieces. So I think when you put it all together, this is why investing is not so easy.
No, I was asking the first question because I also don't have any much money and I really want to invest. So I was really thinking about breaking my 401k as well as, getting that credit card.
Well, I would say that the Columbia alum, Li Lu, should be your role model. So Li Lu came from China, penniless. He did 3 degrees at Columbia at the same time. And he was on student loans. And the float of the student loans, which is from the time they gave him the loan to the time he had to pay the money, he used that float period to invest the money. And when Li Lu graduated, he had over $1 million. Okay. And in some cases, I think he bought some Russian assets as like 1/10 of 1% of, PE of 0.1 or PE of 0.5 or something, So he made some crazy investments and he got there. And in my opinion, that sounds a lot more risky than what I did, but maybe in Li Lu's mind, it wasn't so risky because he may have understood those bets a lot better than I do. So I think that your situation of not having much money is a very common situation for a lot of entrepreneurs and a lot of people. So you really need to substitute money for what's between your ears. And especially in this economy, there are lots and lots of entrepreneurial opportunities where money is not required.
Like GameStop.
So Manish, I'll tell one more fun fact about the Gates competition is there's a cash prize that's donated by Pershing Square of 150,000 for the top 2 winners, and generally it's encouraged to put some of that money into a charitable foundation. So and part of it is just to get people to start thinking about that at an early age. And I know you so maybe it's a 2-for-1 special, but I know you've started the Dakshana Foundation, so maybe we can nudge people to consider that, and would love to just maybe spend a couple minutes on what prompted you to start that and sort of your I think it's a very personal thing, but your approach or your framework for how of philanthropy.
Yeah, well, I think that I think it was Buffett who said that even if you are a slightly above average investor, if you spend less than you earn, over a lifetime, you cannot help but get extremely wealthy. It's just natural, it's the runway and compounding and all of those things. So basically, we are in a very blessed situation. And I think almost everyone in this room is going to end up with more wealth and assets that they can use, which is wonderful. And so in my case, once I could see that we were getting there, we had actually even gone past that point, there were a couple of things that struck out at me. One is that there are really only 2 things you can do once you have more wealth than you can use. First of all, the ability to use wealth beyond a certain number, which would actually increase happiness, is very hard to do. So there's very few things that you could buy which cost a lot of money, which would actually increase happiness. I'll just give you my example. I think that if I owned a second home, it would reduce happiness. It just would add, some remote real estate somewhere and, some pipes burst or some, crazy maintenance issues, whatever. I don't need to deal with that, right? So most things that you would think of spending money on is not going to help you. And the best things in life actually are free. So it doesn't translate. So bottom line is that I could see in 2005, 2006 that we were on a trajectory where already there was substantial wealth. It was going to keep growing and there was no way to use it really. And so there are only two choices when you have more than you need. You can either give it to your gene pool or you can recycle back to society. Those are the only two choices you have. And giving it to your gene pool actually is a disservice to them because the fun is the journey. The fun is having limited resources and carving your own path and figuring it all out. I think Buffett says that if you're Jesse Owens' son, you're not really going to be helped by starting 100-yard dashes at the 40-yard line. You're not going to become the greatest sprinter doing that. It's okay if you get to start 100-yard dashes at the 3-yard line or the 5-yard line, but not at the 40-yard line. So, like he says, give your kids enough money for them to do whatever they want, but not enough for them to do nothing. Right? So once it was very clear to me that a large inheritance was kind of stupid, then you're only down to recycling to society. And, I'm a competitive guy. I'm a numbers guy. So I like to win. And I was really disappointed in the way charities functioned. I always looked at charities and I saw that they would hold a fundraiser or whatever. And 60% of the money went to raise the funds, and whatever. So when I look at, and then the other thing I'd see is they'd have 10 initiatives and there was no measurement which initiative did well. So just like in investing, I felt like I could do it better. So I said, you know what, once I got to 50 million, I said, we'll give away 2% of wealth every year, which will give us about $1 million. And I said, I want to do it in a manner which is like investing, where we look at high returns on invested capital. In this case, it's high social returns on invested capital. And so one of the key decisions Dakshana made, so most charitable initiatives, which are very good initiatives to put money into, do not lend themselves to easy measurement. Most charitable initiatives do not lend themselves to easy measurement. I mean, if you were, donating clean needles to heroin addicts, for example, some inner city somewhere, it becomes difficult to measure. It's probably doing good, probably doing a lot of good. But when you start looking at, what would happen if we change it this way or that way or whatever, these things become just hard to measure. So what I did is I inverted the problem in honor of Munger. Invert, always invert. So I said that I'm only going to look at initiatives where measurement is easy. So I just looked at all the different charitable initiatives and I just threw away everything which would make measurement hard. And I went for the ones that were easy. And so then we ended up with this model where we, train kids for the IITs and med school, because for them to get to those institutions, there's an independent third party that tests. So we don't have control over that test or the results, but we can look at that outcome and know how effective we were. And so Dakshana is very highly effective because every year when our kids take these tests and they go to IIT and all of that, we get to see what we did right and wrong. And if our numbers drop, we then go back and fix it. Every year, we're continuously improving and changing and tweaking how we do things. And that's only possible because we have a feedback loop giving us data. In capitalism, there's a natural feedback loop, which is your profitability. If your business doesn't make money, you are gone. But in charitable giving, if I'm the Rockefeller Foundation and I have $1 billion and I give away 5% a year, I will never run out of money because probably the investment returns are more than 5%. But even if they drop, it'll be 5% of whatever's left. So you'll never run out of money. So you could every year do useless things and there's no feedback loop and you would never really pay a penalty. So the penalties we pay in capitalism for being stupid just don't exist on the nonprofit side. So these were some of the thoughts that led to Dakshana, and actually it worked out way better than I thought. I ended up with a great team, and they do all the work and I take all the bows, and everyone's happy with that. So it's great.
No, it's a very interesting approach, and you don't commonly see, the business approach applied to philanthropy. So I think that combination's, really interesting, and probably you get more impact per dollar. So there's it'll be a good plug for the winners to consider the Dakshana Foundation. And obviously read about it. It's a great cause. I know, Manish, we're getting close to 5:30 here, so maybe just two quick ones to wrap up. One just for fun. I know you have a massive bookshelf behind you. You have a very good reading list on your website. Are there any sort of 2 or 3 favorite books that you have for the classes? Evening reading. Well, Down to Investor and Vapor is number one, but the backable.
This is my most recent book I'm reading, and I really like this book a lot. And I think that I am finding things that I can apply in my life with this book. So, there's the TV anchor on CNN, Sanjay Gupta. This is his brother who wrote the book, Sunil Gupta. And it's actually he's very self-deprecating and great writing style, and actually has many good things to say. And so if you were a startup trying to raise money, or if you were a hedge fund trying to raise money, or if you were a company trying to get customers, any of those things, I think you can apply his stuff in so many different ways. So I'm really enjoying this book. And the other book that is coming out on April 20th, which may be even better than this book, is called Richer, Wiser, Happier. And it's by a guy named William Green. And there are 2 particular chapters that are my favorites in that book. One is the chapter on Nick and Zach, of the Nomad Partnership, Nick Sleep and Case Zakarian. So there's a chapter on Nick and Zach, which is exceptional. And the other chapter is on me. And I'm not sure which chapter is better, but you can decide. But I think those are the 2 chapters you gotta read. And in that book, I'm the opening batsman. So it starts with me, which is why I love the book so much. But anyway, I think Backable is a great book. But even if I was not in the book, I would still recommend it because Nick and Zach are so good. But it's William Green is a very gifted writer. And I don't know how many hundreds of hours I had to spend with him, and how many nights on Indian trains we were together. But we spent a lot of time together, and he did that with all the people he interviewed and stuff, and he just did a great job. So I think that book is going to become something of a classic because just the way he's done it. He's got a chapter on Howard Marks. He's got a chapter on a bunch of who's who in investing. So it's really good. So those are the 2 I would recommend. And just one other thing I would just say is that we were talking about the business approach to philanthropy. So when you do philanthropy, it's a mix of heart and head. You have to combine heart and head. The problem with most charities is they are huge hearts and no head, and that doesn't work. These are great people, wonderful people to hang out with, but useless at running charities. Okay, and you also can't be the other end. You can't be all head and no heart. So it's really a combination. You have to have a big heart, but you definitely need horsepower, coupled with that heart. So I hope you enjoy that, but I really enjoyed this session, and thanks for letting me ask you some questions, and send me all 25 of the picks. That'd be great.
We will, Manish. And look, on behalf of the class, really appreciate you making the time. Thanks for your wisdom on both investing and on life. I know this is very interesting for everyone here. So, and I know you got a very busy schedule. So really, really appreciate the time and giving us an extra 30 minutes. But this was a lot of fun.
All right. Thank you. See you. Bye.